Hello friends, today we are breaking down one of the most important papers in all of financial economics, Fama and French's 1993 study on common risk factors in stock and bond returns. This is the paper that introduced the three-factor model, a framework that replaced the CAPM as the standard benchmark for explaining stock returns. Instead of using a single market factor, the model adds two additional factors, SMB for size and HML for value, to capture the cross-section of average returns. But this paper goes further than most people realize. It also introduces bond market factors and tests whether stock and bond markets share common risk exposures. In this notebook, we'll build the entire model from scratch, extend it to 5 factors, and examine why it works so much better than CAPM. Our standard scientific stack, NumPy, SciPy, Pandas, Matplotlib, and least squares regression from NumPy's linear algebra module. The random seed is set to 1993, the year of publication. The core equation of the paper. The CAPM says a single market factor should explain all cross-sectional variation in expected returns. Fama and French showed that's not enough. You need two additional factors. SMB captures the size premium. Small stocks tend to earn higher returns than large stocks. HML captures the value premium. High book-to-market stocks, so-called value stocks, tend to outperform low book-to-market growth stocks. The critical test is whether alpha is 0. If the three factors truly capture all systematic risk, then no portfolio should have a significant intercept in the time series regression. Before we generate the data, let's understand exactly how SMB and HML are constructed, because this is one of the most elegant aspects of the paper. The authors use a 2x3 independent sort. First, all stocks are split at the NYSE median market cap into small and big. Then, independently, they are sorted into 3 book-to-market groups using NYSE breakpoints at the 30th and 70th percentiles, low, medium, and high. This creates 6 portfolios. SMB is the average return on the 3 small portfolios minus the average return on the 3 big portfolios. HML is the average of the 2 high book-to-market portfolios minus the 2 low ones. The beauty of this construction is that it orthogonalizes the 2 effects. SMB controls for book-to-market by averaging across all 3 BM groups, and HML controls for size by averaging across both size groups. This is why the correlation between SMB and HML is low. Here we simulate the actual portfolio construction. We generate 2,000 stocks with realistic size and book-to-market characteristics, including the negative correlation between size and B- that we see in real data. Small firms tend to have higher book-to-market ratios. The NYSE median market cap defines the size split, and the NYSE 30th and 70th percentile breakpoints define the B- groups. The size split itself comes out almost even, 1,018 small against 982 big. But look at the 6 portfolio counts in the heat map. They are wildly unequal. Small over high holds 491 stocks, while small over low holds only 136. And on the big side, that reverses. 428 in big over low against 153 in big over high. That diagonal pattern is the size and book-to-market correlation showing up directly in the sort, and you can see it in the scatter on the right, where the cloud tilts down as you move toward higher book-to-market. We generate synthetic factor returns calibrated to the paper's estimates: 8% a year for the market, 3% for SMB, and 5.2% for HML. What the chart shows is one realized draw from that calibration, so sampling noise moves things around. The market comes in at 12.5% annualized, SMB at 4.1%, and HML at 5.3%. The middle panel gives the volatilities: about 16% for the market, 10% for SMB, and 9% for HML. Put those together, and the Sharpe ratios on the right rank the market first at 0.79, HML second at 0.58, and SMB last at 0.41. The T statistics in brackets 4.2, 2.2, and 3.1 clear the conventional threshold of 2 for all three premia over this 28-year sample. Let's examine the factor correlations in detail. This is crucial for understanding why the model works. The correlation matrix in the upper left shows the key relationships. Market and HML come in at minus 0.40, meaning value stocks tend to outperform when the market drops. This makes HML a partial hedge against market risk. The scatter plot in the upper right visualizes this negative relationship directly. Market and SMB run the other way at plus 0.30. Small caps amplify market moves. Meanwhile, SMB and HML are nearly uncorrelated at minus 0.06. This near independence is by design. The 2x3 portfolio construction orthogonalizes the two factors. The rolling correlation plot shows these relationships aren't constant. They fluctuate over time, but the general patterns persist. And the cumulative returns confirm that all three factors deliver positive premia over the full sample. The factor distributions tell us about tail behavior. The dashed black line is the Gaussian fit for comparison. All three are close to symmetric, with skewness essentially zero. Excess kurtosis is where they part ways. The market sits at 0.87, modestly fatter tails than normal. SMB is near Gaussian at 0.19, and HML is actually slightly thin-tailed at minus 0.20, so the value premium here is not a fat tail story. The table underneath gives the full picture. The market has the highest monthly volatility at 4.56% and the highest Sharpe ratio at 0.79, while HML has the lowest volatility at 2.62% and the second best Sharpe at 0.58. These distributional properties matter because they affect the statistical power of the regression tests we'll run next. Now we construct the 25 test portfolios, the heart of the paper. Stocks are double sorted on size and book-to-market equity into a 5x5 grid. The factor loadings are calibrated to Table 6 of the paper. Small stocks have high SMB loadings, around 1.3 to 1.5, while big stocks have negative loadings around minus 0.5. Similarly, growth stocks, low book-to-market, have negative HML loadings, while value stocks have positive loadings, around 0.7. The market betas are all close to 1. The heat map of average excess returns reveals both effects clearly. Returns rise as you move up the grid from big to small and left to right from growth to value. In this sample, the size effect is the dominant one. at 0.71% per month for small minus big. The value effect is real but smaller at 0.29% per month for high minus low. Small value tops the grid at 1.81% a month. Big growth sits at the bottom at 0.58. These are the patterns the three-factor model needs to explain. Here's the critical comparison. CAPM versus the three-factor model for all 25 portfolios. We run both regressions on every portfolio and plot the intercepts as two heat maps on a shared color scale. On the left, CAPM. The pricing errors are large, and more importantly, they are systematic. Blue on the growth side, red on the value side, running from minus 0.48% a month for big growth up to plus 0.67 for small stocks in the fourth book-to-market quintile. That structure is exactly the anomaly CAPM cannot explain. On the right, the three-factor model on the same scale. The grid washes out to near white. Every intercept is inside plus or minus 0.23%. The summary underneath puts numbers on it. Mean R squared rises from 0.73 to 0.88. Alphas, significant at 2 standard errors, drop from 12 out of 25 down to 1. And the mean absolute pricing error falls from 0.31% a month to 0.09. These three panels tell the whole story visually. On the left, the alpha scatter. CAPM alphas on the x-axis, three-factor alphas on the y-axis. The FF3 alphas cluster tightly around 0, while the CAPM alphas are spread out. In the middle, the R-squared bars. The green FF3 bar beats the red CAPM bar for every single portfolio, by 15 percentage points on average and by nearly 37 points for small value, where CAPM struggles most. On the right, the alpha distribution shows the CAPM errors are widely dispersed, while the three-factor errors are tightly concentrated near 0. The printed line gives the headline number, a 71% reduction in mean absolute pricing error. These heat maps show the estimated factor loadings for all 25 portfolios. The market betas, left panel, are all clustered near 1.0. This is the key insight. Market beta barely varies across portfolios. That's why CAPM can't explain the return differences. If all betas are similar, CAPM predicts similar returns. The SMB loadings, middle panel, show a clear monotonic gradient from positive 1.4 for small stocks down to negative 0.5 for big stocks. And the HML loadings, right panel, show the value dimension, going from negative 0.4 for growth stocks to positive 0.7 for value stocks. These systematic patterns are what makes the model work. The loadings vary in exactly the right way to explain the cross-sectional return spread. Now we get to a part of the paper that most people overlook, the bond market factors. Remember, the paper's title is Common Risk Factors in Stocks and Bonds. The authors introduce two additional factors. Term, the term premium, is the return on long-term government bonds minus the T-bill rate. It captures duration risk and yield curve dynamics. DEF, the default premium, is the return on corporate bonds minus government bonds. It captures credit spread risk. The paper's claim is that stock and bond markets are not separate worlds. The same factors show up on both sides. In the next two cells, we put that to the test. we'll see term and def account for almost all of the variation in bond returns, and then we'll check whether they buy us anything at all in the cross-section of stocks. We generate term and def factors, the term premium, calibrated to about 1.5% a year, and the default premium to about 0.3%, each with a small market component layered on top. Then we built 7 bond portfolios running from short government paper out to BAA-rated corporates. The left panel shows the two-factor loadings. Term rises with duration exactly as you'd expect. 0.41 for 1 to 5 year governments, 0.74 in the 5 to 10 bucket, and 100 at the long end. Def is flat at essentially 0 across all 3 government portfolios, then climbs monotonically with credit risk, 0.22 for AAA, 0.33 for AAA, 0.55 for single A, and 0.86 for BAA. That is, the credit spread being priced, 1 rating notch at a time. The right panel adds the 3 stock factors on top. Look for them and you won't find them. Every market, SMB and HML loading comes in under 0.03 in absolute value. The bond market is driven by its own 2 factors. Now the 5-factor model, adding term and def to the 3 stock factors. This is where the paper makes a subtle but important point. The left panel is the change in R-squared going from 3 factors to 5, sorted across the 25 portfolios. Check the axis before you read the bars. The mean improvement is under 1/10 of a percentage point. Adding the bond factors buys you essentially nothing. The right panel shows why. These are the t-statistics on the term and def loadings, and the cloud sits right on top of the origin, well inside the plus or minus 2 lines for almost every portfolio. 2 out of 25 clear the bar on term, 3 on def, about what you'd expect from chance alone. So bond factors move bond returns, but once the market factor is in the regression, they do no work in stocks. That is the sense in which this is a 3-factor model for equities and a 2-factor model for bonds, not a single 5-factor model for everything. Rolling regressions test whether factor loadings are stable over time. We use a 5-year rolling window on 4 extreme portfolios: small value, small growth, big value, and big growth. The market betas in the top panel are remarkably stable, all hovering near 1.0 throughout the sample. The SMB loadings in the middle panel maintain their separation, small stocks consistently positive, big stocks consistently negative. And the HML loadings in the bottom panel show the value growth distinction persisting across time. Small high, small value stocks always loads positively on both SMB and HML. Big low, big growth stocks always loads negatively. This stability is important because it tells us the factor structure is a durable feature of returns, not a transient pattern that might disappear out of sample. The GRS test from Gibbons, Ross, and Schenken 1989 asks whether all 25 intercepts are jointly 0. This is the most stringent test of any pricing model. The left panel plots the F distribution under that null, with the 5% critical value marked at 1.54 and the rejection region shaded in red. CAPM lands at 1.75 with a p-value of 0.016, past the critical value, inside the rejection region. CAPM is rejected. The 3-factor model lands at 0.99 with a p-value of 0.48, sitting right in the middle of the distribution. On this sample, we fail to reject it. On real returns, the paper's own GRS test is much closer to the line, an F of 1.73 with a p-value of 0.023, still technically rejected at 5%. The right panel is what actually matters economically. All 25 intercepts stacked up, mean absolute alpha of 0.09% a month, and almost every 2 standard error bar crossing 0. This is the definitive visual comparison. On the left, the CAPM, predicted versus actual average returns. The points scatter widely around the 45-degree line. The model can't explain the spread of returns because all betas are near 1, so it predicts similar returns for all portfolios. On the right, the three-factor model. The points cluster tightly along the diagonal. Predicted returns closely match actual returns across the full range. Small value stocks have the highest predicted and actual returns. Big growth stocks have the lowest. The SMB and HML loadings provide the variation that market beta alone cannot. The improvement from CAPM to three-factor is visually striking and statistically overwhelming. This brings us to the most debated question in asset pricing. Are the Fama French factors capturing risk or mispricing? Fama and French argue the risk interpretation. High book-to-market stocks are firms in financial distress. Their stock prices are low relative to book value precisely because the market recognizes they are risky. The higher returns are fair compensation for bearing that distress risk. Small firms are riskier because they have less diversified revenue and higher failure rates. But the behavioral camp, led by Lakonishok, Schleifer, and Vishny, argues these are anomalies. Investors overreact to past performance, making growth stocks too expensive and value stocks too cheap. The value premium is a free lunch from correcting mispricing, not compensation for risk. Here's the uncomfortable truth. The statistical evidence alone cannot settle this debate. Both stories are consistent with the data. What matters is whether you believe markets are rational but incomplete or systematically biased. To summarize, the Fama French three-factor model is one of the most successful models in all of finance. By adding SMB and HML to the market factor, it explains the cross-section of average returns far better than CAPM. The key innovations are the 2x3 portfolio construction that orthogonalizes size and value, the time series regression framework that directly tests whether factors capture shared return variation, and the extension to bond markets showing that stocks and bonds share common risk exposures through term and depth factors. The alphas collapse towards 0, mean absolute pricing error down 71%. The average R squared climbs from 0.73 to 0.88, and the factor loadings hold stable across rolling windows. Whether you interpret these as risk premia or behavioral anomalies is still debated 30 years later. But as a descriptive model of returns, nothing has matched its combination of simplicity, generality, and explanatory power. Thank you for watching, and I'll see you in the next paper breakdown.